Thank you. Yeah, it was a big pleasure for me to get in touch with you and reactivate my cooperation with BEROC. So I'll be presenting today my recent research with two financial law scholars. It's on SPACs, because SPACs, since the beginning of my career, I was dealing with the securities issues. So initial public offerings, seasonal equity offerings. Then I moved to crowdfunding. Then I started. Well, I researched a lot. Initial coins offerings, so crypto tokens, which are issued by companies to get financing, and SPACs actually is additional new interesting phenomenon, which was in a very big, was very popular in 2010, 2011, and now with all the markets going down, is actually following suit, and so it's almost dead, but it's not yet. And therefore, I mean, why not researching it, right? So we have the full cycle already. And, well, I try to, since it's the first time I'm presenting this research, I try to make it a bit less academic and more entertaining. So I will be talking more about what are SPACs, how they function, and what is the rationale behind them, why companies would prefer to do these strange transactions instead of issuing shares using the initial public offerings instruments, well-established process of getting financing and becoming public and famous and so on. And therefore, the brief outline is that mostly I will talk about SPACs, about US evidence, because there is no much evidence outside of the US. We do contribute a bit here with Italian data, because this is surprisingly one of the most active markets in Europe and the world after US and UK for SPACs. And that's the picture about SPACs activities and IPOs activities. I'll be later talking what is SPAC. So, but first, just see that we're comparing IPOs here with the SPAC activity, and this line shows you that SPACs are peaking in 2021, then going down to Q2. Well, if you continue, it will be somewhere here. And the IPOs as well in blue. So SPACs at some point of time were much more interesting and popular than IPOs, right? But then you see this wave which going up with the quantitative easing, lots of money. Many people try to use the conditions in the markets, get public, get money before investors start to realize that something is going wrong. If you compare, well, the Bitcoin price here, I like to put crypto everywhere where I can, even though there is not much correlation, but you see the same wave here, right? So all the asset prices were following this kind of pattern when we have this peak in 2001, and then the winter time for crypto, winter time for stock markets, and so on. So peak going down, what happened? Why SPACs were so popular? You have lots of industry research, and very surprisingly, not very much from the academia, where they talk about SPACs, that SPACs frenzy, SPACs are great, and it's the best way for companies to get public, and it's so nice, everybody wants to go through SPAC. There was this very famous SPAC of Bill Ackman, who actually collected $4 billion to find a unicorn and to bring it to make it public instead of going through a costly IPO. He failed actually, so he gave money back to investors. This is a very interesting thing in SPAC, that if you are not successful, you just give the same amount money back to investors, so they're quite safe and protected from the downside. And you have lots of successful SPACs when the private company, all of a sudden become public without going through this underwriting agreements about roadshows and publicity, spending money, but you have lots of failures. If you look at the performance of the companies which became public through SPACs, and this is a long-run performance across various industry, you do see a lot of negative numbers. They are not in red, but this is all minuses. So the performance from 2009 up to the third quarter of 2021, if you look on the average, is horrible. I mean, the companies actually lose money. We know that IPOs, 2 years after they going public, they as well underperform. However, And the performance is 10%. Here you see this horrible statistics which shows that the companies which became public actually were losing money on a large scale. And the idea is that why investors would be interested actually to buy shares of such companies if you see consistent underperformance, which is, well, of course, it's on average. So sometimes you have good companies, somehow you have bad companies, but average tells you that it's really minus. Well, let me start before going to SPACs, just briefly outline why the companies go public, why they want to issue shares to the general market and trade, become transparent, having to publish lots of financial information, disclose information to the competitors. Well, the conventional finance theory tells that the company goes public because they get the access to the capital, they get the liquidity, they can grow easily through acquisitions or partnerships, because if your shares are traded, you can buy now companies with shares. Before you have to pay cash, now you just give shares instead, which is for you as a company really sometimes is much more beneficial. And so this is additional advantage. Plus, when the shares are traded, the remuneration of the talented managers is much easier because you just give them stock options, you align interest with shareholders because managers would like to make the company grow, the share price grow, because then they exercise the executive options and get lots of money. So, and more transparency and less asymmetric information, of course, because investors might be worried about companies which they don't really know what's going on inside, right? And with public companies, it's a public status. You have to publish lots of information, be transparent, and therefore investors might be trusting more the company and be more interested to include the shares of the company into their portfolios. How the companies go public? Well, initial public offerings, when you have the investment bank as the underwriter who does everything for you. You just come as a company to them, you pay them quite a substantial amount of money, but they deal with everything. The early evidence, there was a famous article by Chen, which was called exactly, so you don't even have to read the article because it was called 7% solution. So you immediately know how much the companies pay to underwriters on average to get the shares published. We did the similar statistics for Italy, and in US recently it's 4-5%. So if you want to go public, 5% of the money which you will be probably want to raise, you will have to pay to the underwriters for their services. And that's why it's expensive. And many companies were experimenting and where the regulation was permitting, trying to get public via different methods. Some of them is the restricted markets, which is in Europe, in UK was quite popular because these are the smaller market for smaller companies with less stringent listing requirements, prospectus, no prospectus obligation, or restricting the investors which might buy the shares. For example, only qualified investors can buy it, or high net worth individuals. Sometimes there was quite not popular but frequent something which was called reverse merger. It's when a private company which wanted to go public, instead of going through the IPO process, what they were doing, they were simply looking for a public company, traded, small one, in distress maybe, then buying it, merging, getting, of course, the public status because they acquired this company, and changing name into their name. So that's why it's a reverse merger, because you acquire a smaller public company and you become a public company. Sometimes, as alternatives, there was in US this shelf registration, when you prepare all the documents for listing, but you are not listing your stock, you just keep it on the shelf. And then if you decide to do it, everything is almost ready, so you save a lot of time on that. Special purpose acquisition company, SPAC, is another alternative, of which I will be talking a bit later in the next slides. Just to mention that non-conventional alternatives, of course, finance is a very dynamic science, and they just try to use any loophole in the regulation. So equity crowdfunding is when you issue the shares of your companies to the crowd, basically through online platform. and they receive the shares of the companies. They cannot trade it, so it's 5 years freezing period. So it's not very popular at the moment because, you know, it's risky investment and you don't get liquidity. You cannot sell it, so you have to stay with the company. But it exists at some point of time. It existed before and still now, but it's not really popular. Initial coins offering is another topic which I was researching quite a lot. When the companies, instead of issuing shares, issue tokens. So they get money. They bear no responsibility to tokens holders because there was no regulation about that, and many scholars couldn't even agree. What are tokens actually? Is it a security? Is it some sort of a scam or something like? It's nothing. So plus it's crypto, so it's a sequence of numbers. Nobody understood that thing. But companies, many companies, even non-blockchain based, managed before the regulation was not enacted or ICOs were not prohibited, raise some money. So they didn't have to do IPOs, they received the money they needed. But SPACs, special purpose acquisition companies. Well, SPAC actually is a device where some sponsors, experienced investors in the industry, practitioners, would like to collect money. 200 million, usually $100 million, sometimes even more. So they create the blank check company. This is a pure shell company. There is no activity, nothing. In the registrar, it's written that this is a financial company where they collect money from investors. Investors receive shares of these SPACs. Once you collect this money, why investors would do it? Because there is a promise that we use this money, within 2 years we will look for a private company which wants to get public, we will help it to get public, we acquire it or merge with it, and then you have all of a sudden shares are exchanged, you have the shares in the public company without IPO, and given that we sponsors, these guys, experienced guys are called, we have experience in that, we promise you a very good return on that. And as a result, investors give money to the company, receive the shares which are immediately traded, so there is liquidity. You can sell it if you want in the market after the first day of this SPAC IPO. SPAC managers put the money in the escrow account, so nothing happens with your money because this is the money for acquisition, for merger, and the investors can trade it. Plus, they receive not only the shares, they receive as well the warrants, which are the right to acquire the company at some additional shares for a specific price at a later stage. Interestingly, in US, you have to buy the price, for example, so warrant to acquire the share at $11 means that you have to pay this amount. In Italy, the warrants were given for free, and it means that if you have a warrant, you can get the share. So if the share price goes up to about 11, you can convert the warrant into the share at no extra cost. So it's additional thing for investors, right? They receive something which is potentially valuable. They don't have to pay for it. If the share price goes down, you just throw away the warrant. So it's a usual call option. Well, it's the Asian call option because you can exercise it at a specific each month given the average price of the share, but let's not go into these details. If the target is found within 24 months, it's a good thing. So SPAC is successful. If the target is not found, then SPAC is not successful. However, as investors, you don't care because you receive back your money plus interest because it's in the escrow account, some very tiny interest, but let's say you get your money back, right? So it looks to be like a free lunch. You receive the shares. If the target is found, you get the shares in the company. You can sell if the target is found again. You should have to approve it as shareholder. You can sell the shares, get rid of your investment, and realize the return. And in US data, Rita, for example, showed that the average return is 9% annual. And it's almost risk-free, right? Because this is like a convertible bond. Because you have the bond, you receive a small interest, you get your money back if something wrong happens. If not, then you just convert your bond into the shares. Why? Because it's profitable for you. Shares value is much bigger than the value of the bond. As a result, you have a private company listed, funds collected, and investors happy, sponsors happy, everything is rosy, and that's why probably That's why SPACs were existing, right? Looks very nice, like the collateralized debt obligations and subprime mortgages, so just beautiful. How SPACs happening? Well, before the listing, you have these guys, sponsors, which are very important. They try to convince investors, they try to persuade the market that they are able to find the targets, that they have experience. They list the SPAC. Sponsors usually contribute some money because you need to get it going. And as a result, they contribute, they have their skin in the game. They contribute initial resources, which are used to cover up legal expenses, startup expenses, and all these other things. SPAC is listed. Immediately, the investors can sell the shares. What is interesting, the SPAC offering is targeted to professional investors. So if you are a retail investor, and the whole purpose of our first paper was how the retail investors are protected in this setting, you cannot get it. But you can buy it in the market after the listing, right? So immediately the first day, usually, and in Italy, for example, the price is fixed at 10 euros for each share for every SPAC. In US, again, $10. So if you want, you can buy it at $10 and be the investor in SPAC the first day after the listing. If within 24 months the target is found, you can sell your share, you can keep it and receive the share in the target which you acquired, and then you are a usual shareholder because the company becomes public, completely like any other public company on the stock market. Why SPACs have become popular? The first and the probably most plausible argument is the speed. Because with IPOs, you have IPO waves which depend on the stock market and economy performance. IPO is quite a lengthy process, and many companies cancel the IPOs because they are late for the game. Because by the time they want to get public, the stock market goes down. For example, now many IPOs are cancelled because stock market is down, and you cannot just get the money you want, right? Because nobody is ready to buy shares in the risky new companies. With SPAC, it's much faster. And the company which wants to get public, just find any suitable SPAC, agree on the price. The money is in the escrow account, so you receive pure cash. You just give some percentage of ownership to the SPAC shareholders, and all of a sudden you are public. So done. You receive the money, you become public. And that's more probably the biggest advantage of SPACs. Then again, you have sponsors. These experienced guys who lend the credibility, who lend the experience. So this is similar to venture capitalists who take the startup, train the young entrepreneurs, help them, and bring them to success and exit through IPO or strategic sale. Another thing about SPACs is that sponsors have to be sort of remunerated. With IPOs, usually they get the shares. With SPACs, they do get the shares, but these are special shares. So these are not traded and converted into ordinary shares only if the company is performing according to the milestones. For example, if the share price of the SPAC is above $11 on average for a month, then the sponsors can convert their special shares into ordinary shares, and then of course they can sell it. $12, $13, so there are milestones. In IPOs, this is not existent, and that's why it's quite good, because many people, then investors, believe that sponsors, if everything goes very well, then they will receive the shares. If not, they will not get nothing, no remuneration. So this is alignment of interest of the sponsors and usual investors who cannot, who are in SPAC actually quite passive. Then you have lowered threat of litigation. This is really a US issue, because when you do SPAC, this is like a merger, but with merger you are liable to the announcement of the potential cost cuttings and revenues. Here with SPAC you are not liable because you are protected. There is a safe harbor which says if you make an announcement of revenue and it's not actually realized, you are not responsible, because this, things happen. And more certainty about IPO proceeds because you actually know how much cash the SPAC has and what it will give it to you for exchange of shares. With IPOs, depending on the conditions, depends on the book building procedure, then the price is not determined until the very last day. You have this range from 10 or to 20, and then it's decided according to what investors say, how much you were successful in finding the shares. So, seems to be SPACs are quite good. That's why probably many companies wanted to do them. Investors wanted to invest, sponsors wanted to promote, and companies wanted to be acquired. What we find in research about SPACs, well, it's only about US data because the majority of them are from the US. And earlier studies have found that SPACs really destroy post-merger value, right? But based on this sample of earlier SPACs, which are not very many, then you have found that SPACs are very different. There is a very big cross-sectional variation. Some SPACs are quite successful and they bring you a lot of revenue. Some SPACs are really suck and they destroy value like hell. So it depends on you if you're an investor to be able to select a good SPAC and avoid the bad one. Coming in 2014 actually found that very counterfactual finding that actually if you have a big underwriter or sponsor, then you have worse performance, which was later turned objected and overrun by the future evidence, but I just wanted to include it for completeness. There are SPAC waves like IPO waves, so you've seen it on the picture at the start. And why SPACs exist? Because there is a demand. Some people want to invest in IPOs and get the share of the company. Of course, it's risky as well. If you invest in an IPO, you subscribe for a share, it started trading, there is no guarantee that it will actually go up and you will realize your return. Because normally with IPOs, there is something which is called underpricing. So money left on the table where you have the company which deliberately underprice the share so that the investors immediately on the first day can sell it and realize, let's say, 15-20% return. And that is a very frequent, and we did, and many researchers actually studied this underpricing. Well, it's not really guaranteed because, for example, Facebook, who was listed 10 years ago, I think, they issued the share for $38. Right. So if you are investors, even private investors could participate and get the share for $38. The first day it lost, I think, 10%, and then in 3 weeks' time, the price went down to $21. Many investors wanted to sue underwriters because they thought it was actually a scam of some sort. Why they put the price tag so high, 38, when the market actually just decided that the price was 20. Later, the share went up to 100, 200, and nobody actually cared very much. With SPACs, it's a bit more risky because you may fail. You get your money back, right? But the SPACs might be successful and you realize high return. However, some researchers argue that it's smaller and riskier firms who wanted to get public with SPACs. And as a result, there was a demand from risky firms who couldn't go to IPO, so they were getting through the back door, getting public with SPACs. Well, I managed to lose in editing one more slide because there was two recent papers, one by Klausner and another by Ritter, where they studied the phenomenon and they showed a very troubling results. If you are a SPAC investor and you don't redeem your shares, so you don't receive your money before the merger, what happens is the share value of $10, which you have, on average, transfers to $5 of cash, which is in the SPAC account. Why? Because of the conversion of special shares, because of the conversion of warrants, what you get is that you are losing money. You acquire something for $10. If you don't redeem and get out at $10, so you're not realizing nothing, you are acquiring a company, but effectively for $5. So half of your investment is already gone. If the company price is growing, my merger is successful, good. Then you actually compensate. But if not, why investors would do that? Rita found that if you sell the share before merger, you realize on average 10% return. If you keep it with till the merger, so you're a long-term investor, you are losing something like 30%, 40%. And so this US evidence was quite troubling. They found as well that sponsors is not a very lucrative business. So there is no SPAC mafia, guys who actually put companies in, convert their shares into normal shares, sell it and get out. Well, that's not like that, they showed. And we were quite interested because we had the Italy data. And it's very different, this setting. So in 2012, there was regulation on SPACs in Italy, and they started to appear. By the moment, we still have quite a few, really, 30, but it's the third largest market in the US. So for law and finance paper, the sample of 30 is quite okay. For pure finance paper, of course, you cannot prove much, but we tried to do something. And we looked at the retail investors. Are they protected or not? Because, you know, the regulation has to deal with the equitable way all the investors are treated. And the retail investors are usually the small guys who go with the flow and they're taken advantage of by the big guys, you know, the whales, the large investors, and so on. So we tried to look whether the retail investors participate in this market. And we looked at the institutional investors. Do they participate in the market? A couple of hypotheses we put forward. Then we studied that if there is a SPAC mafia in Italy, actually, and we looked at the long-run performance of SPACs and target companies after the merger. We also look at the cost structure. So whether it's really that the dilution is such huge that with a 10 euros share, the net cash value of the share is 5 euros by the time of the merger. We calculated long-term performance and tried to see whether there is dilution and when it happens. When the companies are doing quite well, so the price of the share grows, or when it's not unrelated. So additional part of the research is on the contingent remuneration, which is called earn-outs in the US literature. So that's we are still trying to bring into shape to understand how it's going on. So what do we see? Well, Italian market comparing with US is tiny because in US you have 70% of all the worldwide SPACs. If you look at Italy data, we have something like 30, but 6 of them are not targeted to retail. So for the first paper, we actually had to limit ourselves to the small number. 25% of them failed. One still were trying to look for the target, but by now I can say that they will fail because they will not find anything. So it's additional failure. We find that we just got the trading data from the Italian stock exchange and we looked at the deal. So we got actually all the tick data and we looked at the distribution of the data. We found that all the trading is quite small. Of course, it might be algorithmic trading going on, so all the large institutional investors split their orders into small ones, but you still have quite substantial number of big orders, but the majority is actually less than 2,000. So that's an indirect evidence that retail investors do participate in SPACs. They cannot participate in IPO, initial one, but they can buy the shares in the market afterwards, right? And they seem to be doing that. Institutional investors actually participate in the IPO. They get the SPAC shares, but what happens is that if you were the original investor in the SPAC, by the time of the business combination, so the merger, you actually try to offload the, just get out of the business. Why? Because you realize the return, you get your, of course, not spectacular return, but it's safer because if you stay with the target, your long-run performance is actually negative. So this is what happens, and the qualified investors, the institutional investors, they know about that. Some investors which didn't participate in the SPAC, they acquire the shares in the market, they build up their position, but before the merger, again, they sell the shares and they realize return because they know that whatever the target might be, it's very unlikely that you will earn money. We find that there is no SPAC mafia in US. There are lots of banks and institutional investors participating there, but the It's quite a lot of them. So there are no 2, 3, 5 big players which actually govern everything. Warrants trading, it's quite interesting why investors would be participating in this SPAC listing. Well, because they get warrants. They get it for free. It's not attached to the share. So you get the share and the warrant. You sell the share. And we do find that they sell the shares. But you keep the warrant. Why? Because it's an option. If something goes well, then you receive additional upside potential for free. And that's why it's better to sell the share for a fixed amount for a small profit and then realize the higher return potential with a warrant. Of course, if you are a retail investor, you don't get the warrant. Warrants are received only by original SPAC investors. And you can buy it in the market, but this is a derivative. And of course, if you're a small investor, it's highly unlikely you understand what is a warrant, how it works, and so on and so forth. So the dilution. We find that it's not really so dramatic. Remember that in US data, they show that this number is something like 55%. Why? Well, because you have the dilution of special shares, right? If the managers, if the sponsors convert the share, you lose. Because before you owned, let's say, 50% of the company. After conversion, you owe only 30% of the same company. So it's a loss. Plus warrants conversion and plus the expenses, because the company SPAC, you do have expenses. Most of the time, sponsors contribute their own money for that, but to calculate the dilution, we arrived at the number which is very, very modest, 17%. So really not a big deal. Why? Because you have the long-run performance. In US data, they show that the performance of average of SPAC is really complete failure. In Italy, we show that it's not really, after comparing with IPO market of market-adjusted return, it's, let's say, 0. And the higher is the share performance, so the higher is the dilution. So dilution happens only contingently on the stock market performance. And, reporting this figure actually misleads or overestimates the losses of investors because they're compensated by sharing price increase. And so that's actually where we are at the moment. We have a bit of data to work on the remuneration and put it into, let's say, academic shape and study some additional phenomenon. But SPACs seems to be quite an interesting thing. After researching initial coins offerings, I thought there will be no more interesting and crazy thing than tokens offerings, but SPAC seems to be sort of on the level. And I finish here.
So let's take questions first.
I had a number of questions at the beginning of your presentation. Maybe it's an issue of clarification to you. For example, you show the performance of SPACs, which is very low. So I'm wondering which part of this performance is due to recent decline in shares. Like
I think it's
which part is general trend.
This is from research institution on SPACs Insider. So I didn't.
It looks very dramatic. So I'm suspecting it's due to like last couple of years when SPACs
I think so.
Well,
not last year.
So you want to separate them like during decline of the stock market during.
Yeah, exactly. So for our research, we didn't find this because we looked the 1 year, 2 years, and 3 years performance, including the recent downfall. So it's much less dramatic. So here it might be more for marketing.
Less dramatic. Yeah. Second is I think the slide before that you were showing number of SPACs over time. So I think another statistics that everyone would want to know is a volume in terms of dollars, as opposed to just number of those, I believe, over 1 million.
Well, if you look at the value, which I didn't report here, US, of course, it's 80%, 85% of all the value, because this is a big
as compared to IPOs.
Exactly. And both IPOs and SPACs, because in US there is much more money. So the average IPO and average SPAC is much higher. So the value will be even more dramatic.
It is larger than IPO?
Yes.
Okay. The third thing that I noticed when you contrasting with IPOs, you mentioned that IPOs are expensive in terms of like 7%. I believe it's much more than that. It's at least for two reasons. It's underpricing that you mentioned. Underpricing is at least 10%. So So,
Yeah.
so
Well, that was only the fee of the underwriters. Of
right,
course,
but the effective cost to the company is much more than 7%. It's 10%
that's true.
underpricing.
Plus, you have the
There is a green
roadshow
option,
expenses.
green shoe
green
option
show,
as
yeah,
well, which also adds another couple percent. So it's much more expensive.
That's true. Yeah.
And let me mention one more thing is out of all presentation, I found, like, I didn't know much about Spark, but I found very surprising based on Italian data that they give warrants for free. So like we know how to price warrants. We basically see it as equity. So it's extremely strange to, I mean, you can just write paper just out of explaining why they're given for free as opposed to.
And the price is from our data, because we get the trading data for warrants. It's so the price of the share is 10 euros, and the price of the warrant average is €1.50. So you get 15% gain plus the upside, right? If you convert it. Maybe, yeah, warrants are quite interesting because the problem is that to understand them, you have to spend a lot of time on derivatives and so on. But that's an interesting idea. Thank you.
Anyone else? Okay, let me abuse my right as a moderator.
Please.
And ask a stupid question. From what you have presented, I know nothing about SPACs, but it doesn't seem like a complete bubble, right? It seems like a legitimate business model. So why do you think there is such a discrepancy between the promise and the results that we see?
In the US data?
In the US data, and yeah, another question is why Italy is so different.
Well, because there are different regulation. There was in US in 2013 they actually changed the SPAC regulation because they realized something was going wrong. Because to dissolve the merger, if the shareholders vote against it, it's blocked. They receive the money back, but they can sell the shares and still vote for the merger. And because after the vote, the share price goes up, they keep it, sell it later on. So now these two decisions are sort of separated. In Italy, Italy is an interesting country because they surprisingly have a very good regulation. Even compared to the very developed financial markets, and they have very good reporting, so lots of data and everything. The problem in Italy that it doesn't work, so the regulation is there, but it's either abused or not implemented properly, because what we found, for example, that you are not allowed to trade shares. The shares should be stopped trading after the announcement of the merger and before the approval by shareholders to avoid this some sort of speculation. What we found in 60% of the shares, they continue to be traded because we have the trade data. We contacted the stock exchange, why is that, and we didn't get any reply. So I think here it's just the demand from private companies to get public, and SPACs were a very good solution offered by some of the, let's say, financial engineering geniuses. And before the regulation catched up, like with ICOs, like with subprime mortgages, like with tranches of collateralized debts obligations, before that, some people tried to earn money and they managed, but the rest were actually, when they were late, losing it. So my understanding here as a researcher is it's just the way to avoid costly reporting, regulation, accountability, and transparency through the usual IPO process. And that's why there was a demand from companies and there was a supply. Of course, now that the stock market goes down, there is no demand and there is no supply. So that's the only thing I think is as a possible answer.
Okay, thank you. Any more questions? Okay, I don't see any hands, so let's give an applause to Dmitri.
Thank you.